Morning, everybody. Good morning.
Good morning.
To start with, how many of you are startups? Just raise your hands. And any investors? Because we should be careful. Okay. And what are the remaining people? Like, where do I classify them? You're curious to understand or? To be an entrepreneur. Okay. Sitting on the fence. Okay. Okay. The subjects which both of us chose to probably deal with are very basic stuff. Because, and before that, people with commerce background, can you raise your hands? Okay. We have to be careful again. We can make mistakes. Okay. Seshadri and me worked on this, I think a week back we thought about it and then we decided that we will split certain sides between us. To begin with, our backgrounds, even though we are from the same profession, Seshadri has been for a long time in the US. So he has seen much more things than me. Probably one of the very few shareholders of Warren Buffett's company which I have seen. He holds shares in whose company. He attends Warren Buffett's, the famous AGM at Oklahoma. Okay, so his experience is totally different from mine. I am purely from the Indian angle. Can we go to the first slide? The agenda for the day is basic financial concept, choice of entity, capitalization, fiscal issues, regulatory approvals, startup funding, fundraising. Yes, let's move on. Basic accounting assumptions. Basically, every organization or even you take an individual, you have assets and liabilities. So the house I own is that I consider it as my asset. The loan I have to pay, basic knowledge things. But what is this capital? Can somebody, this will be more an interactive session. Can somebody tell me what is this capital? Pardon?
Money which is required to run the...
Okay. But money can come from capital, debt also? Okay.
The owner's contribution.
The owner's contribution. That is the capital. Debt is with something, an enterprise or you borrow. So debt has a lot of terms attached to it. You have to repay it at a particular period. Or if it is a working capital loan, it may remain with you because it will, as the business grows, you may require more loans. But if you are taking debt, normally it has a term saying that you will repay. It's typically a house loan. You will repay it over a period. That we call what kind of a loan? A term loan. Because it has a term. The other one, working capital loan, is what we call normally cash credit. It depends on the volume of the business. Suppose the volume of the business grows up, the bank will give you more money. And the business, because when the business comes down, the bank will recover that money. And it is a cyclic process. The other one is a steady thing. You have a particular period, you have to repay it over a particular period. Okay, let me just move to the other item. Income. What is this income? Pardon? Louder. Sales. Don't you have any other income? Services. What else? Agricultural income,
Any other income?
Rentals.
rental, interest. So like an individual, a business may all have all these kinds of incomes. Okay, move on to expenses. What are these expenses? Salary,
Overhead.
advertising, material purchase, all your sales expenses, all are expenses. But there are certain expenses which we don't feel because the other things you are paying out. What is that? Pardon? Okay, I agree. But still, you have a car. The value of the car in the first year was 15 lakhs.
Brother.
Depreciation. What is that?
The loss in the value.
Depreciation of the asset. But that is an expenditure. But you are not, it's not a visible expenditure immediately, but actually your asset is depreciating, so that's another expenditure. There are certain other expenses also like that. You would have invested in a huge advertisement and the results are over a period of say 5 years. So there is a question whether I should charge the whole expenditure in the first year or defer it over a period. That will come later. So profit and loss, what is that? The difference between your income and expenditure, which will also include this hidden expenditure like depreciation. Okay. I think we will move to the next slide. I have explained a little of these things. Capital expenditure, revenue expenditure, because once you incur an expenditure, it can either generate an asset or it can aid in your business. Asset creations are all capital expenditure because that will form part of the assets in the one side of the balance sheet. And revenue expenditure will go to the profit and loss account. Am I clear, or do you want further explanation? Because once it is expended, it is all gone. Whereas my fixed expenditure is somewhere available as an asset. Accrual basis, cash basis, what is it? Some basic concepts we are trying to bring in.
Accrual will come in at a later date. It is accrued but not received actually.
Okay.
It comes in your books but not necessarily in the bank account at that particular date.
Okay, I can account expenses on two bases. One is when I incur expenditure or when I pay the expenditure. What is the difference between I enter into a contract, I start getting the supplies. At that point, I have the liability. So that is accrual expenditure accounting. Is it clear? But small organizations account it only, typically these charitable organizations and all, they used to account it only when they pay the money. But now for tax purposes, we have only accrual. So in accrual system, you will have certain liabilities which you are accounting now because you are enjoying the benefit of that services now.
If I can add, salary is a classic example.
Yes.
Somebody provides service, let's say through November, you pay them, probably your law says you pay only by 5th, so you probably pay on 2nd, transfer it to the bank account, but their service is all the way through November, so that's one.
Yeah, one classic example of that is suppose you are preparing a profit and loss account of November, you have to include the November salary even though as an expenditure, even though your bank pays only on 5th of December. So that is the exact classic thing which Seshadri has brought in. There are so many expenses like this. So you have to be careful when you prepare your profit and loss account because you already have a commitment for accounting. Okay, and consistency, because your policies have to be consistent. Either you have to be on cash basis or accrual. Now the tax and the government wants everything on accrual only. So we will talk about accrual only. Going concern, what is that? Can somebody tell me what is a going concern?
Infinite life.
Pardon?
Infinite life to the firm.
I have a business which I believe will continue. If I am closing it today, it's not a going concern. So, businesses are going concerns normally unless we decide to close it. So, one of the principles of accounting is that I have a business which is running, the liabilities I am creating are going to be paid. Otherwise, there is a full stop. There is no full stop in this business. It's a continuing process. That is going concern. You want to access balance sheet, profit and loss account, cash flow. I think we will go straight into that. Before that, okay, let me also elaborate on assets. There are some non-current assets are there. What are they? Assets are fixed assets and current assets. Current assets are which you are deploying in the business like raw material, work in progress, finished good, receivables. Fixed assets are your factory or your car or your computers, which is all available with you. The other one is coming and going out. What are these non-current assets?
Your patent, all those things.
Excellent.
Goodwill.
Your patent, sometimes your software licenses, copyrights, because these are assets. Actually, you have spent money on that. It's not seen. Especially patents are not seen. But you have an amount sitting there. You have a valuation sitting there. Current assets are normally cash, bank, which is easily realizable. There are also in the current, there are also liquid assets which are bank and cash, whereas your receivables will be a little difficult to collect, which is not a liquid asset. Income we have dealt with.
So the definition goes that current is whatever you can recover into or turn into cash in 1 year or less, and non-current is something that you use for longer than 1 year. This is the how.
Yeah, in typical what you call our accounting standards tell us.
So that's how you decide whether it falls under those categories. So the example that you gave about patent, that is in use for business for let's say 20 years. So that is why it's a non-current.
So when it comes to income, sales are there, services are there, interest are there, and all. But there are certain other income also which appears once in a while. Can you give just an example of an income which suddenly appears once in a while? Interest is because normally it comes,
Somebody said sales of an asset.
Yes. Once in a while you may sell one of your cars. Once in a while you may sell one of your very big asset. Assume that your sales for the month was only 30 lakhs and this particular sale is 40 lakhs. So we call it a non-recurring income. Because suddenly your income that month will shoot up to 70 lakhs, but next month it will fall again to 35 or 30. So in MIS we always classify this as non-recurring. It doesn't show the real business potential of that month. Then there can be non-business income also. Very rare. Try one example. This will be more an interactive session. That's why I am asking questions. Very rarely it happens.
IT refund if any.
Pardon?
IT refund if any. IT refund.
Yes, some of those kinds of
Answers.
non-business incomes can come. Can we move to the next one? You want to take over?
IT returns is considered as an income?
It is not an income. It adds on to your cash flow. It's a non-recurring sort of thing which adds on to your cash flow.
So there's the interest on it.
There may be an interest on it. What? Expenses, cost of goods sold, employee cost, administrative cost, depreciation, interest, taxes, one time, all this we have dealt. Profit and loss account. I think we move to the next slide which shows. Okay, capital versus debt. This is one of the hot topics which we always come across. This is one core area where we start our, probably we make, as advisors we make money. Whether you should fund your business with capital or a mix of capital and debt, or very high leverage, that is 90% debt. How do you decide?
Depends on the type of.
What is the type? Can you explain a little more?
Depends upon the availability.
Availability of
Fund.
debt or...
Either.
Oh, I have a business. Assume that I leverage it 90% debt. How do I repay the debt?
Cash flow based on ROI.
Based on the cash which is generated in the business. You can call it return of investment or how much profit I can make in the business. That's the key element to decide whether it should be my fund or whether I should borrow. Am you are understanding it? So basically you have to do a P&L, profit and loss account, to see whether cash generation will be sufficient to manage your debt. Because debt can come in different ways. I told you it can be a term debt. So there may be a monthly repayment of installments, or there can be a working capital debt which need not be repaid immediately, because as the business grows the bank will be happy to again deploy their funds because they earn interest. So this is one crucial area, because we have seen a lot of businesses go bust because they borrow more.
It should be based on P&L or cash flow.
I will come to that again. How much, that's why I said how much cash is generated. In this world of finance, cash is king always. Whether it is your own money or whether it is somebody else's money, cash is king. And when it comes to funding, I said you can have 100% your own funds, you can have a mix, or you can have a high leverage of debt, depending on the servicing capability. We call it the debt service coverage ratio, how much you can service. Okay, I have a very good business, I can leverage it, I can repay the loan. So I go for the model of high leveraging. I am quite comfortable with it. But do you think it is always wise to remain on debt alone?
So when you have debt, we usually say you are depending on the kindness of strangers, like whoever sends you or is willing to lend you money, you're dependent on them. If you don't, especially if you don't have cash flows coming into your business, then it's time to repay. Regardless of whether it's business, personal situations, or even countries have gone bankrupt. Argentina, if you look at it. So that's where debt is always a big question mark.
So finding the suitable mix is the basic question. Whether I should fund it with own funds or a combination of equity means own funds and debt, or I can leverage. But typically you see that housing loans, probably you leverage up to 80-85%. Why? These are given to individuals and their repayment capability is assessed by the banks. The same person who starts a business goes to a bank, will he get 80% funding? Because your assessment is based on the business cash profit. The other one is you have a fixed salary or you have a fixed income and they think that you can say out of it, they can leverage up to 80% of the house. Here they may give you maybe 40%, 50%. So that mix is the crucial thing. And one more thing, which is more expensive for you, a debt or a own capital? Why? You said own capital is more expensive. Why?
Debt might be costing less if we take it outside. But investing the capital will be more important from the.
So the key thing here is,
So capital can be used at the time of revenue.
yeah, capital is the most, own capital is the most precious thing. But using a judicious mix of own capital and debt is the challenge. Because with a small capital, if your business is good, you can leverage it, make it big with debt. It all depends on your cash flow, as you have said. So in startups, some of your startups, we always say that bootstrap yourself to the point it is possible. After that, if you dilute your equity, that is the own capital, to somebody else, that's the costliest thing. If you can still manage with your debt, you are not diluting your ownership. When you are diluting your ownership, actually somebody else is coming into the picture and probably he is sitting in the back seat, but he is seeing how you are driving. The more you dilute, he will move to the front seat. The more you dilute, sometimes he may take over the driving. So, dilution of the capital, that is your own equity, is the most judicious thing a startup has to decide. So, typically a profit and loss account will look like this. You have sales, services, operating expenses. Depreciation is the unseen expenditure. So in the books you will have a profit of 10 only. But in the kitty, how much money you will have? You will have 30. So this is one thing which we always look before any banker or anybody who is funding. They will try to see how much is you will go with your profit and loss account saying that this is my profit. But they will drill it again and see how much is the actual cash generation. We just wanted to show that. So this is how the normal allocation of a business takes place. Equity, debt, land, building, equipments. It can be anything. For IT company, the whole thing may be different. Office equipment, net working capital. We will go a little more into the working capital. I think this is the crucial thing of any business. You have cash. then you buy materials, or in an IT company you employ people. So from cash stage 1 you move into the next stage of work in progress. You have always some products in work in progress, or you have some manufacturing goods in work in progress in the factory, or you have services which is continuous. It will all be in certain work in progress, and then it moves to finished product services, and then you make a sale and then you recover it. This is what we call the working capital cycle. So which is the costliest point in it? Pardon? No. Receivables is the costliest point, because you start at cash, you buy material, then you add or you use your people to develop a software product, then it becomes a finished good. Then you are applying your sales people to sell it. So at each stage your cost is increasing. Typically you take an example like Hindustan Liver, soap and detergents and so much manufacturers. They have a cycle. So you buy raw materials, coconut oil and all stuff for the work in progress, and then they finish good, and then it moves to receivables, and then they sell. One typical thing about Hindustan Liver is, when they sell through this AIF or Woodful dealers. The dealer has to sign and give a check at that point. So Hindustan Liver most of the time doesn't have any receivables in their books. Typically the car companies like Maruti and all, they have a financing company. The moment the car is dispatched from the plant, the financing company steps in, which is again a joint venture between one of the Countrywide and Maruti. They immediately pay Maruti. And the dealer actually pays Countrywide back. So in the books of the manufacturer, the receivable is eliminated. And the classical example, which is a little difficult to explain. You take the liquor business. Day 1, the manufacturing starts, bottled, sold out. Maybe within a month, the whole money comes back. So your working capital cycle turns how many times a month? 12 times. And in a year, sorry. Assume that you make 10% profit in one cycle. What will be the yearly profit? 120. Take for instance another business where your working capital cycle is 3 months. And you make again that 10% profit only. You make only 40%. So the profitability again goes into a different angle. How many times you are able to turn your cycle? So look for businesses probably which has the shortest working capital cycle. Even though your profit margins may be low, but still the magic will be that in the end your overall profitability will be very high. Am I sending the correct? So businesses, that cash generation which he has talked earlier, purely depends on how efficiently you are able to manage your working capital. Is it clear?
So, if I may add, to compare to HUL, Hindustan Unilever example, compare the same thing to what, say, Nykaa does. There was recently a conference call where this was all discussed. And Nykaa's cycle is almost 40 plus days. So you can imagine what it does to the profitability. Same segment, right? Almost FMCG category. So that is the big distinction between I mean, that's what separates the boys from the adults, if I may use that example.
Yeah, we always think that we are doing a great business, but when you enter and drill down only, you find all these things which why I am not making money like the other guy. Go, please.
You have spoken about tangible goods like manufacturing. Can you bring it to a service industry and explain how?
Sure, same thing. What kind of service industry you are in? Give me an example. Okay. Here you are selling actually rooms. Packages. Tour packages. So, tour packages means when do you collect the money? So you give vouchers when they land in the airport?
Yeah, they pay full money before it starts.
Okay, so that's right. You collect the whole money and then only you settle the hotels. That's an excellent business, but your margins may not be very high. So it depends on purely how much is the traffic, how many people you are able to manage. You want to add something? Again, comes back to the same working capital. How many people you are able to turn?
So, this is a lesson I learned 25 odd years ago when I started working. So, I'll just share that big thing with you. I still look at business the same way. So, the quote I heard is, sales is vanity, profit is reality, or profit is sanity, and cash flow is reality. So this is the first statement I always go to in any business. And this is what typically any business owner should do. Nothing else matters in your business. This is what you should first look at. I know for startups this may be hard to figure out, but if you're running a traditional business, this is the first thing you should go to. Everything else is, because profit is like we saw, there are accruals, there are uncollected funds, so those are all opinions. They may or may not happen in the future. So this is what is more important. So the classification that you're seeing is also related to what you saw earlier. Operating activity means whatever is part of your recurring business and whatever generates cash. So you will find depreciation being added back, any accruals being adjusted, any uncollected or receivables being added back, things like that, to the profit. And investment activity means whatever you are investing in the business. So if you're buying a plant if you're buying a car, usually that gets as a investment activity outflow because you are spending. And any sale of assets that we discussed earlier, that will show up in here as the investment cash flow. And financing is either whether you raise debt, paid interest for term loans, non-working capital type loans, or whether you paid dividends or raised equity. So that is what comes under that. And then it gets reconciled to your cash or bank balance that you have, or similar cash type investments that you may have.
Let me just add two things there. I was for 13 years in industry before I came to consulting. So one thing which unfortunately sometimes, because when you work in large companies, you have quarter to quarter P&L pressure. So there is always, used to be, I think some of the companies still do, there is always a quarter end sales dumping on the dealer with an understanding that dealer will pay only later. So you declare huge profits, listed companies, market price goes up. The company actually in the next month finds that they have to run to the bank to run the company because you don't have collections. Typical example of that is where the sales vanity turns into hard reality of cash. Second is there are some companies, they will have two kinds of operation. There is an operating activity, there is an investment activity. Sometimes you will see that this investment activity generates more money than the operating activity. I would not try to invest into such a company because this is an investment company, not an operating company. So you have to make that, you have to drill down the figures and find out whether it is actually there, the business is the core activity or the investment is the core activity. They may say that we are in software business or something else. Profitability may be high, but the whole thing may be they have made earlier a lot of money which is invested and they are making money. And there is another thing also which comes in most of these companies who deal with foreign clients. There may be windfalls in foreign exchange. Sometimes the dollar may go up, sometimes it may come down, it can hit you back, it can. So always people will always say that you can hedge against it, but hedging is all a 6 months business typically. Around the world it is again a 6 months with a future correction. So these are kinds of things which you have to go through the figures and find out whether whether they are making money in foreign exchange or operations or something else. Go ahead. Yeah, typically when you are small you are a proprietorship. When you go a little bigger you will move into partnerships. That's the normal process. And India has created another structure, limited liability partnership, which is essentially again a partnership with certain limited liabilities. The next stage is when you grow bigger, you move into private limited companies and then public company and listed company. See, what happens is from that limited liability partnership onwards, it takes a little time to liquidate the entity. If you are comfortable, you can remain as a proprietorship. But nobody else is going to invest in you. Your business can be small. Partnership means you are a little more broad, you have more partners, you have more people to work with you. The difficulty of the partnership is the liabilities actually drill down to each partner. So one partner may do something wrong, the liability passes on to every partner and their assets. So limited liability partnership protects you to some extent on that. But private limited company is the company where investors would come in and invest because they are getting shares of the company. You will have a shareholders agreement. It's a more structured thing. Public company means you are exposed. Your figures, even private limited companies' figures are now exposed. You are more exposed. Listed company means you have all the drill of stock exchange reporting, quarterly. Everybody expects the shares to go up. A lot of things. Typically, both of us are in Kerala Angel Network. We invest in private limited companies only, not limited liability partnership because we don't want to take any land. See, this equity investment can be resident investment, that is the people here. Foreign direct investments, almost every sector in India is open 100% foreign investment other than press, defense and a few critical sectors. Or retail, there are some restrictions on wholesale retail, different store retail and all. NRI investment is also 100% into all sectors. Sectoral caps I just said. Automatic route means after investment only you report back to RBI. There is no prior clearance. So FDI, foreign direct investment or NRI investment can come. Only thing is that sectoral cap. Almost every service industry like software, travel, everything is except plantation, defense, press and some selected industries. Rest is all 100% automatic. You don't require any prior approval. Only thing is your banker reports back to RBI That reporting is required because at some point, if you want to close the business and repatriate the funds, that reporting is required. There is a registration, which is post facto, not prior. India is so liberalized in those FDI thing. Debt is term loans, debentures. Term loans are the typical ones, car loans or whatever, house loans. Debentures are specified for a particular period with a particular interest, and then there are convertible debentures also. Typically in CAN we invest through convertible preference shares, which is actually at the investment point it is a debt with the valuation on the equity. I think you will explain it. Bridge finance is suppose you have a term loan going on and suddenly you require some money. It is typically a bank finance.
Yeah. So what you're seeing on the screen is the sequence of what your funding should be. So like we said, equity is the most costly, so that is what you'll find at the bottom. But you start with bootstrapping, which means you use your own funds, and then if you're a startup, there are other avenues where you can get free money. So one is through hackathons and contests, and so that typically applies for a tech business, and even Kerala Startup Mission has done among other non-tech hackathons as well. And then the other sort of source of money is business incubators and accelerators, because they support you with, say, providing a seat, plus some training, some additional resources. Again, going back, Startup Mission is another big example for an incubator. Accelerators means that they essentially, once you are at a stage where you are ready to, say, with a prototype or ready to scale, accelerators come in and accelerate your business, help you speed up. And I'm dropping this term crowdfunding here because there is a lot of misinformation among startups that you can crowdfund here. You cannot, in the sense that crowdfunding, the way it is understood in the US and other markets, is you pool investments from smaller investors, from starting from $100 you can raise. In India, the regulation says that you cannot offer anything as a return against funds that you source. So Kickstarter type of crowdfunding, you offer products in return. So you finish a product, send it across to the person who funded you by $100, $1,000, whatever it may be. So that is the big distinction in how people understand crowdfunding. And when you are a private limited company, there are also limitations on how many investors you can even invite. A lot of people don't understand. Even platforms did not understand until they started getting notices from Ministry of Corporate Affairs. So when you think about crowdfunding, think of it as you are taking advance from customers, and not the other. It's called Reg CF regulations. So not the Reg CF regulation is not what we are talking about here. And then there are government programs, a lot of grants depending on what category you are in. So this should be your first priority if you are starting out. These things are what I call as free money, easy money. Not so easy, but then these are free, you don't have to return them. These are grants.
I just want to add, we have maybe 3 or 4 clients who have so far funded up to 1 crore. Their contribution has been only 10 lakhs or something to start the business, startup. Two are in medtech field, so product development takes a lot of time. Up to 1 crore, actually, they have funded through the Government of India projects like DST, BIRAC. So if you have a product which is under development and DST, BIRAC, there are so many schemes to fund. Kerala Startup Mission and the incubator at Calicut and REC, the other one at Seshadrinathan, they all have fantastic schemes. And I sit on some of the investment committees there. I know the kind of money which is available with the government. Only thing is you have to tap it correctly, you have to do the incubation correctly and things like that. In one of those companies, at a later stage, Unicorn Ventures put, I don't know whether any Unicorn people are here. Unicorn Ventures, one of the large fund of funds investors put 2.5 crores, and I think after 3 years, Fishers of Singapore have invested and Unicorn has exited 50% at a huge 10x or something. So this is the kind of money which is available. When it comes to angel investment, we can invest at early revenue stage, not on idea stage. There are people like 100x VC who invest on idea stage. 100x VC typically invest 1.25 crores on idea stage for a 15% stake in the company. But we at CAN look at revenue earning companies in the early revenue stage. Probably, maybe it can be 5 lakhs monthly revenue, 10 lakhs monthly revenue. What we are looking is 18 to 24 months of cash flow gap. That we are willing to fund for a stake between 5 to 15%. We are looking, because after 18 months we would like the company to reach a particular milestone and raise the next round of funds, say within 24 months. And that 24 months fund, maybe a portion can maybe putting as a follow-on round, but a bigger player will come with a bigger valuation. Typical example is one investment, I'll just quote, Cooked. We invested when the company were 10 lakhs per month revenues. This is a video streaming platform which shows you all the cooking. They have 2,000 videos or something, and millions of followers on Facebook and things like that. After 1 year, they started selling the ingredients for the cooking. We came in when they just started with 10 lakhs. 2 years down the line, I think we came at a valuation of something like 23 crores. 2 years down the line, they are doing 2 crores per month. And the follow-on round, we have just put a little bit of our money at 45 crores. 8 months down the line, they are going for a private equity funding of probably 80 to 90 crores valuation. So the kind of the structuring is important. Assume that you concede 25% of your ownership in the first round. There is no space for the second party to come in and the third party to come in. After once the second and third party comes in, you will become non-promoter. Are you understanding me? You concede 25% in the first round, second round another 10 or 15, you are already 40 gone, and the next round you are non-promoter. We don't want such a situation because the whole funding is on 3 pillars. How you can ramp it up, scalability, equally important promoter. The promoter is not right, we just have to write it off. And the third is, are you disrupting something and doing a different thing?
So the promoter part, we look at a lot of things. I will not talk about any example from here. In Mauritius, I have a partner, and we were talking about an Indian promoter there. And so he mentioned the name of a company in the conversation. So I said, I have heard this company's name somewhere, and we Googled together. So this guy had left to Mauritius after there were a lot of investor cases against him after multiple rounds of funding, and then he was trying to do similar raise in Mauritius for another business. So a lot of things get looked into. We value the integrity of the promoter a lot more than what returns can come from the business. Just to highlight that part.
Yeah, because the moment the pitching takes place to us, most of the time the social media of the promoter if you go through, you will know who he is. Because he will have all sorts of social media things, his connections, and all those things will at least give you a 50% idea about this person. One thing I missed, SME listing, that's a new thing because many companies go IPO on National Stock Exchange, NSE, and now they have a second board which is lower called SME listing board, where smaller companies can list. So if you are, say, probably in the range of 200 to 300 lakhs and good profitability, SME listing may be an option, because that's sort of a nursery where your listing regulations are not so complex or rigid as the main listing. And NSE and BSE, they are trying to bring these companies first into the lower level and then upgrade them into the next level.
So there are, after 3 years, you can automatically go into the main board if you said we are ready. And I have had this SME listing for a long time, and last 2 years the interest level from the participants have been much higher because they have heard of stories of investors getting few 100x returns after SME listing. So a lot of you may have read about that in the finance.
Yeah, and I think National Stock Exchange is coming around and doing investor meets both in InfoPark and Technopark. And InfoPark, I understand 2 companies are in the SME listing process. Technopark, 2 companies are listed, and the third one is in the process.
And some of the regulations are soon going to change. I was just inquiring for a SME listing candidate, and SEBI is going to come up with some newer, updated regulations soon, is what I understand. So. Yeah, any type of company. I think the criteria is 3 years of existence, plus you have to have certain, you have to be profitable in 2 out of 3 years for one exchange. The other is 2 out of 5 years, and there is small net worth criteria. No, limited companies.
It should be a limited.
Only limited companies.
See, from private limited, if you want to list, you will have to convert to a limited company, because limited companies only get listed. Tax is income tax, everybody knows. What is this transfer pricing? GST and customs duty, everybody know. What is this transfer pricing? Yes. Suppose you are doing an international transaction. Suppose your company is the subsidiary of an Indian company, and the international company buys same services from somebody else. So the pricing which you do should be comparable. Otherwise, what can happen is, you have a profit center here, you transfer money, sales at cost to the parent, and your Indian profit and loss account will show no big profit. The government of India doesn't, no country wants it. So there is an organization called OECD, which is all the countries are members of it across the globe, some 140 countries. They say that each country should get the minimum profit of the operation done there. Because many of the software companies, their value addition takes place here. Then they transfer the product to US, where you have sales and third party liabilities. So they take the overall profit, split the profit, India portion, US portion. So you should be pricing your sales or services, otherwise the tax department falls on you. There is another thing called safe harbor rules in it. It's a little higher level, I don't know whether I should deal with that. If you declare a particular percentage of profit, you are not further employed. It depends on whether you are R&D business, whether you are a product. It ranges from something from 15 to 30. So you might have heard in recently that one of the big automobile companies in India has been shock caused with 1.3 billion on transfer pricing issues because they manufacture in India, they transfer to the parent globally and sell the products. So there are some issues on the pricing.
In the interest of time, I think we should quickly move on.
Yeah. How much time more we have? Over. Okay. Cross-border funding repatriation, all of the exit options. Okay. Regulatory is you have this NCA, which is a Register of Companies, Income Tax, GST. STPI is because every software company in India is supposed to register with the Software Technology Park. Softex is the particular certification the Software Technology Park issues saying that these people are actually exporting software. These are all regular processes which all these software companies undergo, KSUM, DIP, MSME, reporting, periodical, annual compliance audit. These are all routine things which everybody goes through.
But one thing is if you're starting up, make sure you register with Startup Mission if you're based in Kerala and DAPP as a startup. It opens you up for a lot of benefits and subsidies and you get to know a lot about schemes.
At least I think you have KSUM has got at least 10 to 25 lakhs to give you. KSIDC and KFC has got very soft loans at 8% or 5%. Depends. They come out with the different schemes. A lot of money is there. Only thing is you have to tap it properly. You have to. The key here is the compliance. Because if anybody wants to give you money, they want you to comply with all the regulations. That is the Companies Act, Income Tax Act, all those things.
So I think this would be a good place to stop. But let me just walk you through. You would have heard some of these terms like pre-seed, seed, Series A, ABC, all of that. At least you would have read about it. So the classification comes from which stage of you are at as a startup, whether you are thinking about a product and whether you have a prototype and at what stage of sales are you at? Are you just do you have your first set of customers? So that is what defines all this. And the reason I'm bringing this up here is the investor who invest at these stages are also different. So at a typical pre-seed stage, like we were explaining earlier, a lot of angel investors will not touch you. So that is the stage where there is no product, there is no revenue, you are thinking about something. So only people who can invest are your friends, family and alumni that you know about you.
I will just add, there are 3 F's actually. Friends, family and fools also invest. Don't take it in an offensive way, but they are also required at times.
So I usually get a lot of pitches about ideas. So I tell them this is not the stage you should reach out to angel investors. I mean, there may be exceptions, and you will get to know more about them once you talk to them. But that's the stage, pre-seed stage. A lot of people don't invest, and sometimes you get support from incubators which are at early stage as well. And then once you get to the seed stage, there is something tangible to show. There may be some early revenue generation. So this is the stage where angels come in. Also, early stage VCs tend to invest. VCs don't usually invest up to this stage, but there are some early stage VCs like 100x VC or there are a few others. And so when you pitch, you should know that if they invest in that particular stage, that is very critical. And then startup accelerators also can support you at this stage through acceleration programs. And then Series A is where the big money comes in. So this ABC, naming convention comes from again US Valley, and the idea is that A, B, C investors have different rights, and they invest at different terms and at different valuations. And there are other sort of terminologies that they use for. If you say raise 100 crore valuation one round, and then you went to 80 crore because of market conditions in the next round. It's called a down round. So there is another terminology for that. And then once you get into Series B, C, that's now where BCs tend to be the investors, or PE firms sometimes come in at that stage. Even sovereign wealth funds have funds looking at that stage. And mezzanine is just a bridge round, so if you are in between rounds. So let's say you started thinking that I have enough money for 24 months, but you ran out for different reasons. You do a bridge round or a mezzanine round. So these are the different terms that you will come across. And
one more thing. In one of the TiEcons like this, Natarajan, we call him Nat, who is the fund manager, who was the then fund manager for Ratan Tata's family office was here. So I asked him, this is particularly on valuation, I asked Nat, how do you take the valuations of the companies? His quick answer to me was, Roy, there is nothing like valuation, there is only a value which I see in the company. Point number one. Point number two, Shakespeare has famously said, the beauty is in the eyes of the beholder. You may think that you are handsome, you are beautiful, but the beholder has to decide whether you are handsome or beautiful. Third thing is, when a company pitches to us and says that, look, I have a similar product which is in the valley, their valuation is 10 million, so I am looking at 5 million, we see the first red flag. Because nobody is comparable, no service is comparable in the world. These are my final words.
we are open to questions.
Three questions only, in the interest of time.
Okay.
You mentioned the cash flow cycle as one of the most important things for the business point of view. But there are businesses where the cash flow cycle can be quite long, sometimes maybe a year, and it's probably immensely profitable. What are the things to consider in those scenarios, and how do you ensure that you set up the organization for success on a continued basis where it is that long?
Probably if you look at construction business, contracts is one area where there is a long gestation period. The only thing there is you should have sufficient margins. Otherwise you will get a cash flow trap. Construction is one major area where long contracts, government contracts, you will have long gestation period for payment of bills and all. Probably at that stage I think banks fund you in between the gap.
Yeah, you have been telling about this cap table, that is total 5% or 15% is decided. So when company grows, usually your equity goes up. We don't know the projected equity that is we are going to reach. So how will you decide that 5%, for example, can told 5%, 15% is our minimum requirement. So when the company's capital grows, this will obviously come down, or it's fixed in the start itself.
I'll explain the CAN thesis once again also. Earlier we used to fund as individuals. Now we are going through the SEBI accredited fund, and there will be only one entry, even though in one investment which is going to get announced, we are putting 2.2 crores. Malabar Angels is joining with another 60 lakhs. The entry is in the cap table, only one entry, which says lead angels can that particular company's name. That answers at least partially one of the questions. The cap table, nobody wants the cap table to have 50 people on the entry side. On the dilution part, we are never fixed on 5 or 15 or whatever it is. But if somebody dilutes beyond, if somebody comes to us with a 20% dilution already, we are a little scary. Because he has already surrendered 20% of the company. Take for instance, he may have to give another 8 to 10% on employee stock options. So that goes up to 28 to 30. Where do we come in? And we want the next rounds to come at a higher valuation. Do you understanding me? Yeah, that's the key point.
So my question is, how you fix up this, for example, your
Okay, I understand on the conversion. See, the company comes to us with a particular projection. So we subscribe through a convertible note, CCPS, which has a base valuation as well as a cap. Sometimes we may freeze the base valuation itself. We will convert after 2 years, or when the other round happens, whichever is earlier, at a X valuation. And sometimes we may even, the promoter may be quite smart. He may say, base price is this. The cap is this. You will get a discount sometimes on the conversion based on the other round which is coming. So there are a lot of ifs and buts. And don't think that the money immediately flows. Money flows in tranches only. Sometimes we may open an escrow account where the money is kept, because we also need to know that he is achieving certain milestones. Sometimes the money may go immediately. It all depends on what is the requirement. You want to add? Am I clear?
Are there any more questions?